Do you think that this debate around Fed independence is going to come proper to the fore again?
Trump is not the first president to criticize the Fed. The concern is if the president got what he's asking for, the ability to remove Fed governors, that basically means the president can wipe the slate clean and put a whole set of governors in. I fully expect the chair to be someone who agrees with him. What I don't want to see happen next year is his ability to remove anybody else like he would want to, because then you're basically handing the keys over.
Welcome to Year in Business. We're joined by Claudia Sahm, Chief Economist at New Century Advisors and a former Federal Reserve economist. Claudia, there's a real fear out there that the US dollar is going to get even weaker. It's being called the debasement trade. I look at gold, currently in excess of $4,300 an ounce. Bank of America says $5,000 an ounce could be in the offing for 2026. What do you make of the huge moves in this asset class?
Right. Well, I think, first starting with the dollar, because I think it is important to look at the asset, they're connected, but they're not tightly interconnected. So with the dollar, it's really important that we keep context in mind. So we came into this year with a really strong dollar. So some of this, the declines in the dollar are a process of probably, normalization, reversion to a mean. But then we do, there certainly have been concerns about, how safe an asset the dollar is for certain actors, right? Like that this is something that came up after Russia invaded Ukraine and the dollar, their access was limited. And so I think there are some structural changes happening. I don't see this as, the end of dollar dominance, but that we're even having that conversation should raise some eyebrows, right? Because if you lose a reserve currency status or even it's weakened substantially, that's a process that happens over a long stretch of time. That's not one event kicks it off. In terms of thinking about gold, that certainly has been, a place where you want to think about the fundamentals behind it. Again, there could be some shifting away from the dollar in terms of reserves for certain countries, certain types of investors. But then if you look, you get into the more recent space, there's a thing called momentum. And sometimes, you have asset classes that move beyond just kind of our fundamental stories. So we do have to be, careful in balancing out, what's happening. It's a complicated picture right now, and I certainly wouldn't want to give advice on where this goes next. But I think it is, these big grand stories like dollar disbasement, U.S. losing reserve currency. I'd be really cautious about playing those up as the explanation. They might be in the mix, unfortunately, but, that's a gradual piece.
The Fed chair a couple of days ago was asked during a fireside chat if the Fed spends any time looking at gold, given sort of how radical the moves have been. And he said that they don't really look at it. Do you believe him?
Well, the Fed looks at everything, right? And they need to understand this has been a huge question in financial markets. And it's a movement that is unusual, particularly when you have assets moving in outsized ways or relationships have seemed to be shifting. Like the Fed wants to understand what's happening in financial markets. Now, I think it was a very responsible answer from Powell in that just because they're looking at it, trying to understand what's happening, doesn't mean that they're then going to take it the next step to intervene, right? Like they're not targeting a dollar level. They're not targeting a gold level. They're not going to step in. But it could be, I'm not saying this is happening, but the reason they watch these assets is sometimes you can get information about where, the economy might be headed. Right. And the Fed does react if it thinks, growth is weakening, employment's weakening, that inflation might be picking up. So they're going to look at all the information. It's just this question of what would they actually react to, or what would they say, well, this is, a fundamental level we're targeting. They're not doing that with the gold or with the dollar. I mean,
with gold prices up 60% year to date, I think we can all admit that it's worrying and it's a red flag. And I listened to what Axel Weber was saying. He was the former chief of the German central bank. And he says, every time you doubt governments, you go to gold. And this is something he said to MarketWatch just in the last few hours. I'm wondering whether there's maybe another angle, what's happening with the bankruptcy of two auto-related firms. Do you think that's maybe also playing into sort of the appetite for gold, the pain and sort of the shortages in the private credit market?
Well, it is we are in a moment where, at least episodically, we've seen recently some flight to quality, or even last Friday, some of the announcements about more trade tensions between the US and China. And that really rattled markets, and that, you're looking for safety. Well, gold, I mean, that historically, that's a place, that would be a place to go to in times of turmoil. And this week, we've seen some rumblings in credit markets. Right now, there are these one-off-ish kind of events against a backdrop of, credit has been, we have the spreads are really narrow. We've been in an environment that's been really good. There are these signs of stresses, and there's been a lot of reaction to that. When that happens, it's very natural to see some movement towards the signs of safety. And that's one where but we do have to be careful of, just because people are a little on edge, the market has been, and also we haven't talked about, but stock valuations have moved up quite a bit. And there's also this concern about, is there really ground underneath that, right? And these are conversations that should be had. One should always be skeptical of these movements. But there's a thing you have to watch with the markets, is that the narrative kind of takes hold of itself. And I think right now there's a lot of looking for the pressure points. And we've had days where you seem to see things kind of move in the direction of being really concerned. And then we get some good news the next day and it backs it up some. So, it is something to watch, but but as with any, big outsized move, it's going to be a really complex explanation behind what's happening.
I want to pick up on what you mentioned in terms of tariffs and what we saw in terms of limiting rare earths out of China exports. Is this going to feed back again into inflation? Because if you're obviously restricting key materials from the U.S. economy, that will have a choking effect, is it not? At a time when we just thought that the worst was behind us from an inflationary perspective.
So we absolutely learned during the pandemic that massive supply chain disruptions can be inflationary, right? So we had, for very different reasons, we had supply chains break down. And again, in some of the same spaces that we're talking about, like with semiconductors, going into the auto industry, that was extremely disruptive during the pandemic. And it not just caused inflation directly, but it even caused some waves of inflation. I think particularly looking at, say, what happened with the auto industry, we saw car prices go up, and we saw car part prices go up, and then it showed car insurance. I mean, this really lasted over a period of time. So the supply chain disruptions, if they are severe enough and they last long enough, which I think is an important thing to remember in these trade discussions, then they can, because they can disrupt production. Even if these are relatively low-cost inputs, the rare earths are not expensive, but they are a key piece to a production process. So if a production and there are, inputs, inventories built up. So this isn't an immediate thing, but it is the case that if those, rare earths, if there were the export controls, if China did pursue these, if they kept them in place over a long enough period of time, it would bring production in a wide range of goods industries. It put it under a lot of strain. And if you don't have enough supply to meet demand, well, you get higher prices, right? So yes, it is an inflation risk.
Is it your sense that there is quite a bit of posturing going on ahead of the meeting between Presidents Xi and Trump?
Absolutely. Right. So November 10th is the expiration of the second 90-day pause. Early in the spring, we had these, triple digit tariff threats from the US and from China, and that those were lowered in the spring. And we're getting close to one of the end of a pause. Right. So all of this is about negotiating. Well, what then going forward from November, are we going to lower the tariffs against China? Are we just going to extend the pause? How long is it going to be extended? And the rare earths are one of the main leverage points that China has in this process, because it's an important input to production. So yes, we are absolutely seeing, and as you mentioned, Xi and Trump are set to meet towards the end of this month, which would typically be the time, when the leaders meet, there should be some kind of an arrangement that's come together that, that they can kind of put a thumbs up on. So that's absolutely where we're at right now. But I mean, I think it's important to realize that the United States raised tariffs across basically all countries. I mean, like the tariffs are higher than they were before this year. China is the only of the major countries that have, tried to retaliate in any way. So this really, this is a trade tension that we don't have going with a lot of the other countries. And so even if it's posturing can get out of hand, and we could be set up for a period where it takes them time to actually, they have to implement some of these threats, and then you get to an agreement. So it could be a pretty bumpy road here for the next month or so.
You spend a lot of time combing through the economic data, and I was looking at some of the inflation figures, and I began to wonder how accurate the inflation metrics really are, given that the federal government has been cutting back on data collection. They just aren't enough people at the moment to do the job. How alarming is that for you?
Right. So the statistical agencies, I mean, they have been operating in an environment with budgets that have been pretty much flat in inflation-adjusted terms for several years. Now, it is true that under the Trump administration, they've lost many staff members. They're also facing additional budget cuts and some just difficulties with contract workers that are necessary to go collect the information. Now, I will say that the leaders at the agencies they understand the limitations of their resources, their staffing, and so they have to approach this in a triage sense, like how much detail are we going to do, which different survey programs. And I will say the statistics that tend to get the most attention, the kind of principal economic statistics, so like the consumer price index, or the employment statistics, they're going to move resources to make those happen. Now, we have seen within the CPI, they've limited some of the collection areas. They're trying to find ways to marshal their resources such as they are. They have the ability to kind of do, I'm still comfortable with the data that's coming out of the agency. I still think that it's the best that we have. I think it's a big mistake to starve them of resources, because it's not just about keeping the quality of our statistics, maintaining it, it's actually about improving it, right? And with less resources and less people, they're just not going to be able to do that. So I do have concerns about quality, but I'm still looking at the CPI as one example, as kind of that's the best estimate we have. So we need, and frankly, right now during the federal government shutdown, I find it kind of unsettling because we're missing all these federal statistics. They are not perfect, but it is really, it's really problematic just not to have them. Now, we will get to CPI with a delay next week, so I am happy to see that one coming out.
If you could improve something about the inflation measurement systems in the U.S., what would it be? So, that's assuming that there is something to improve. Because you hit on that and you said, it's not just about maintaining, it's also about, pushing the boundaries and sort of exploring new territory. Where would that be in sort of in CPI, or, could be a new version of the CPI, right? I know that's sort of, quite out there, but anyway, that's one of the reasons we have this podcast. We can do these things, right? So
I think giving the Bureau of Labor Statistics the ability to kind of to go down the path they're already on, but with more vigor, I think would be important. And to be concrete about it, that, much of the consumer price index and really a lot of the federal statistics, they're based on surveys. And surveys, the beauty of a survey is it's, a smaller sample, so you don't have to go out and census the entire country. And yet they're designed to be representative. We really do need to have a picture of what does inflation look like in the country as a whole, not what does inflation look like at Amazon, right? Like you could have one private company's data and look at what they're doing with prices, but that's actually just a piece of the puzzle. We want to know for the country as a whole. But the problem is, I mean, the surveys have gotten more expensive over time because people aren't as willing to participate. So it takes you got to go back to them over and over again to get them to respond. And sometimes they don't respond. And then your very carefully designed sample, well, it's not going to be as good. Like you really need those to work. So then it's kind of thinking about like, we're never going to get rid of surveys. There are some things that you just like need to go and ask people, ask businesses, but where you can use other information, bring in private sector data, put it into the statistics. And the CPI over time, like airfares are not collected by survey. They use online prices, and the same, they have, similar things for auto prices. And, so like just helping them move to a system that is more cost effective and more robust, I think is the first thing. And then, timeliness is always something to keep pushing on, right? And I think, there were efforts like with the housing inflation in the CPI is a very slow moving object, just the way it's constructed. But it really would be good to be able to break that apart in terms of, well, what's the CPI of housing for the people just getting their new housing contracts? And there are some experimental measures and some estimates they've worked on, but it's like trying to really, beef those up, integrate them more into it. I think that'd be a direction kind of analytically, like really being able to understand like what's happening right now. I mean, because for like policymakers like the Fed, they want to react to that inflation, not some contracts that are, a year old. I mean, that's very backward looking.
Yeah, I hear what you're saying. To everybody watching today, we would love to hear from you. Drop a comment below. So take a moment to hit that like button. We would really appreciate that. Claudia, how would you characterize the health of the U.S. economy today?
Yeah, the economy's a tough one to read right now. In that, we have since the spring, there's been a real slowdown in job creation in the U.S. And you go back to like the how to improve the statistics. We also potentially have learned from the initial estimates of what will be the annual revision for the employment statistics. That slowdown in job creation, that probably actually started last year, right? Like it came again in the spring, but I mean, the preliminary benchmark revision for the level of employment for March of this year, it was almost down a million workers. Now, out of 150 million, you have to keep this in perspective, but it does change the perspective. So we have this environment of either this year, but probably more likely, we've seen over the last year, we've had some really low levels of job creation. Now we are coming out of a business cycle, the pandemic, we had some like massive job losses early on, massive job creation. And then we're in this period of, job creation has really stalled out. And it's possible when the dust settles on the numbers that we've actually been losing jobs in recent months. And at the same time, if you look at measures of consumer spending, GDP more broadly, including business investment, it's we're still expanding, right? So you have, it's a little, they're always a $30 trillion economy. There are always going to be puzzles in trying to understand what's going on, but it's not a balance. Like something is likely to give, right? Either a lot of the, the spending measures, which can be very like it takes time to get a picture of those. It could be that they're just really overstating the resilience. We should be watching the employment, that's weakening. But at the same time, we've had some big shifts in the labor force. We have a lot less immigration. We have an aging population. This may just be, we may be in a slow job creation world. And if you look at something like the unemployment rate, or we are still getting initial claims to unemployment insurance, they don't look very worrisome. So maybe a little bit softer, but so I think it's like the pieces of the puzzle don't quite fit together well, which makes it hard in terms of, the big question, well, where does this go in terms of forecasting? I think it's very useful to think in terms of scenarios, like ones where...
Right, so that would have led to my follow-up right here is, how would you describe the likelihood of a recession in the next 12 months?
So I put the likelihood of a recession modestly low. So in the kind of 30% range. I mean, at any given time, a recession in the next year, 15 to 20% odds, right? Just kind of historically. I mean, recessions do happen. We will have another one at some point. I look at the labor market and what it's get labeled as weakness of these job creation numbers. I think a lot of that's structural. So I don't think of that. I think things could really slow down in terms of creating jobs and potentially even in the growth space, but not in a, I don't see it in a cyclical, like a recession kind of things fall off a cliff. I think more of kind of a muddle through. And, you know, but we are, one thing I would say is even in the muddle through, this low hire, low fire labor market, a very concentrated labor market. I mean, out of healthcare and education, there's really not a lot of industries producing jobs. So you've got narrow base. It's a risky place to be, right? We don't have the buffers that we had earlier in this recovery when, say, the Fed decided to raise, interest rates 500 basis points, right? There were a lot of buffers in terms of a labor market was very strong and still a lot of demand and balance sheets of households. Firms look good. So we are more fragile. So if some other event were to happen, like, we were talking about some of the concerns that have shown up in markets about, well, maybe the AI is over exuberant, or maybe there are pockets of credit risk. If you had some event that really built up, well, then we don't, in the quote unquote real economy, and like particularly the labor market, you don't have the same buffers. So like the risk is there, it's elevated, recession, 30% or so, but I don't see that as the most likely path, barring some other bad event. If we have some other bad event, like, all bets are off here. You don't have like I said, you don't have the buffers that we had earlier.
I mean, you've gotten quite a bit of fame for the development of the SOM rule, which is an indicator used by the Federal Reserve for identifying recessions in real time. How applicable is that today? And, what would you tweak about it to kind of accommodate 2025 going into 2026?
Yeah, so the past year was a real humbling experience for trying to use the labor market to predict recession. So with this SOM rule, which is, looking at changes in the unemployment rate. So specifically the formulation I had, look at 3-month average of the unemployment rate, current month's value versus low over the past 12 months. It's increased a half percentage point or more, we're in a recession. Not like a forecast, but like that would be within the early months of prior recessions. Well, we hit that level last year. And I had said at the time, and also kind of foreseeing that's where it was headed, that like the SOM rule could trigger, and we are not going to be in a recession. Because last year we were still, creating jobs, we had GDP growth. Like if you looked around at everything else that was happening, it didn't look like a recession. So what was going on? Well, we were having some really large shifts in the labor force and the supply of workers. I mean, this was the piece of immigration. Last year, we were in the tail end of a big increase in immigration. Well, if you bring more workers into the labor force, it often takes time to get work, and you can get a higher unemployment for like a good reason. Because you have more people, they're out looking for work, and then they're going to eventually get jobs and the unemployment rate will come down. That very much looked like the dynamic last year. Now we are in the flip side of that, where labor force growth has slowed dramatically. It might even be declining, but I mean, it's with the immigration really shifted starting last summer from being a positive to a negative in terms of thinking about labor force growth. And so then actually that kind of pushes down on the unemployment rate. So this time, I mean, I pay attention to the unemployment rate. I mean, I definitely pay attention to the unemployment rate. And is it rising? I'm paying a little less attention, like with the SOM rule and the 0.5, because I know that given the dynamics of the labor supply, which is kind of the Achilles heel of using the unemployment rate, because it's out of the labor force, I'm a little less like, oh, but it's not at 0.5, so we're safe. Because there are reasons why it's probably being pushed down some because of the lower labor force. So, I mean, I think it's useful to have metrics. The summer was absolutely not the only one of longstanding recession indicators that fell by the wayside last year. I mean, the inversion of the yield curve also took it on the chin. That was another big one, and we'd had
that was huge.
Yeah. So I think I chalk that up to this has been a really curious cycle. Like the pandemic was not our typical kind of recession. It certainly wasn't our typical kind of cause of a recession. It was a non-economic event, and it was the whole cycle was extremely disruptive. And to some extent, we're still working through that in say the labor market. We have a very this low fire environment. But if you look at the whole cycle, well, it's pretty typical, the amount of hiring, because we did so much hiring early in the recovery, like historic levels. So I think it's hard to, this one is just, and by the same token, like I don't throw away the Somro or any of these other indicators just because in a cycle that was unusual, but it does help us, kind of, you need to know what's behind. What are the assumptions that make indicators work? And, having big swings in the labor supply, that is certainly not one that's going to, make an unemployment index work very well.
I'll tell you what else is curious, Fed credibility. And, the person who sort of fanned the flames of this debate again was Bank of England Governor Andrew Bailey. And he said he's very concerned about threats to Fed independence. He says, and this is a quote, "A sudden or significant change in perceptions of Federal Reserve credibility could result in a sharp repricing of U.S. dollar assets, including U.S. sovereign debt markets, with the potential for increased volatility and potential as well for global spillovers." I see the new member at the Fed, and that is Stephen Myron. He's, of course, a person firmly from the Trump camp, a strong believer in aggressive rate cuts. Do you think that this debate around Fed independence is going to, come proper to the fore again over the next 12 months?
All right. So we got a bit of a breather. Things had really been escalating. I mean, Trump is not the first president to criticize the Fed. I mean, there's a long history. I mean, most presidents want lower interest rates. Like, that's also not a new thing, whether they say it out loud or not. But what happened during the course of this year is it moved from words, we want lower interest rates, insults, Powell is a moron. I mean, we were in the space of words, and then it slowly started drifting towards actions, and not just threats of actions, but actual actions. And I think the real warning bells went off when the president tried to remove sitting Fed Governor Lisa Cook over unproven allegations of mortgage fraud. And this moved very quickly in August, from like when the first allegations were put on social media to when the president tried to fire her, and then Governor Cook, filed a lawsuit saying, you can't fire me, and has been in place. And so this because the issue there is that Fed governors, one of the protections of Fed independence, and independence just meaning that there's like space from short-term politics. Like, the president can't actually say, hey, I want lower interest rates. And the Fed says, oh, okay, well, we have to do the lower interest rates, right? Like, it's just breaking that control of interest rates and keeping it away from the politicians. So one of the protections is, well, the Fed governors, they serve for 14-year terms, so very long terms. Over time, they're staggered. So no president can come in and just reshape the whole Fed, right? Like, it takes time. And then Fed governors can only be removed for cause, right? So they don't serve at will. A lot of other, even from federal agencies, the heads do. And the president was arguing, well, I get to decide what cause is, and I've decided this, rise to that occasion, and she needs to go. Now, this has gone all the way up to the Supreme Court, who the breather said they're going to hear arguments in January about whether she can stay in her role as her case proceeds. And that was a big one for her, for the Supreme Court to say she could stay, and they're going to have hearings, because the concern is if the president got what he's asking for, the ability to remove Fed governors for cause, and he determines for cause, and no one can say otherwise. Well, then that basically means the president can, wipe the slate clean and put a whole set of governors in that, a majority, or, and that's where, like, I don't have a concern. Myron coming in, Myron is still serving at the White House. He's on leave. Like, that is a big no-no. They should not be doing that.
I was just going to say, isn't that a bigger concern?
Yeah, this is it's just, they have an explanation for it. It's just, his term will be up in January, blah, blah, blah. But it's like, no, this is just, so I have a problem with that. Like, because it's not a respect for the institution, so, but in terms of, like, when Trump, next year he'll be putting a chair in place. I fully expect the chair to be someone who, agrees with him on, like, lower interest rates. That's part of the process. That's a normal process. What I don't want to see happen next year is his ability to remove Cook and Jefferson and anybody else like he would want to, because then that's, like, outside of the norm. And then you're basically handing the keys over. And that's where, but I think what's been interesting is, there were all these discussions about Fed independence and trying to explain why it's important. And yes, really, the Fed does matter. And, like, and markets didn't react much, even as, like, Cook was, president removed her or tried to remove her. I mean, she stayed in her job the whole time. But I think there's this kind of view in markets that we're really not going to go there. Like, the president really, because it's kind of, it would just blow things up in terms of, because you'd have not just interest rates would be much lower. And the Fed has tools not just to lower short-term interest rates, but with their balance sheet, they have tools to lower longer-term interest rates. I mean, that was something they did during World War II to support the war efforts. I mean, so, like, you can have coordinated efforts, and then a period of, ultra low interest rates would likely lead to inflation, and that would cause, so there's a whole chain of events that, a non-independent central bank would kick off. There's been a lot of discussion. There's been a lot of hand-wringing and worries. But I think at this point, markets are saying we're not going there. So we're not pricing it in. And I do take some comfort. Like, the Supreme Court, they said earlier in the year the Fed is special. It has to be only removed for cause. It appears that they're going to keep treating the Fed as special. But we really won't know. How they decide will make a big difference in this.
The whole world, from Tokyo to Riyadh to London, is trying to figure out how many rate cuts the Fed is going to deliver in the next 12 to 18 months. With everything that we talked about in the last 20 minutes, how many rate cuts, are we going to get?
Right. So I expect through next year, even as you have a new chair come on, that the Fed will stay in its kind of business as usual, which means it'll be reacting to the data, right? And I think this, the projections that the Fed officials put together their September meeting, I think are consistent with what I described as the muddle through, right? Like, the unemployment rate goes up some, not too much, growth slows down, but stays pretty close to trend. Inflation slowly gets back to 2%, right? So you kind of move along. Well, if that's what happens, well, then, the kind of typical Fed official has few cuts next year. So we're probably going to get a few more cuts before the end of this year, because the labor markets have, look kind of questionable. But then really, like, maybe a cut or two next year. So not much. And I think it's very consistent with the muddle through, especially because the expectations, it's going to take some time to get inflation. Even if these tariff-induced effects are temporary, they've been slow moving. And the Fed really shouldn't get completely back to normal or neutral until they're convinced inflation's coming back down. And I think that's just going to take some time. So the difference of opinion, next year markets are a little bit more optimistic in terms of rate cuts coming faster. But on some of that, it's a be careful what you wish for. I mean, a Fed doing a aggressive cutting cycle next year is a Fed that's reacting to an economy that is deteriorating, right?
When I caught up with Jim Bianco quite recently, he said that his concern was lowering rates will produce too much stimulation and result in higher interest rates at the long end of the yield curve. Agree, disagree?
I think that's so I disagree, but I think Jim and I are coming at it probably, because again, I use as a preface, I think the Fed will still be in its business as usual reacting to the data, right? And so I kind of this baseline, I don't think Trump is going to be able to reshape the entire Fed next year. I mean, that's like using that as a baseline. So it's like, I would agree with him in that case of the Fed just kind of de-anchors from data, just starts cutting rates really rapidly. That should absolutely have that effect of putting, if they're getting out ahead in the rate cuts, well, then inflation expectations should go up. You should see premiums going at the long end to kind of counterbalance it, unless if the Fed is under the control of the White House, they might do some things to bring down long rates. But that's the thing is, I think as long as they're following the data, then you're not going to see that imbalance. But I mean, it's not that there is a forward-looking aspect to it, and they can get it wrong, right? And then right now, they're in a place where it's kind of like the concerns about the labor market, though the unemployment rate is still very low at 4.3%. They're doing this year they'll have probably done by the end of it like 0.75 percentage point in cuts, which is not a trivial amount of cuts. If it turns out, well, that was just a head fake on the labor market, this is all structural, well, then you could get that scenario where they've moved too much and inflation picks back up, and growth picks back up. So I wouldn't rule it out, but I don't. Again, I think. I think that a Fed following the data, if we see aggressive rate cutting next year, it's because we're seeing a deteriorating economy, and then it'll be you won't see that reaction in the short and long end that Jim was talking about.
Yeah, that's a very interesting point, Claudia. I want to ask you a few personal questions. How did you get into economics to begin with?
Yeah, I was an undergraduate at Denison University, small liberal arts college in Ohio. And, I took economics my freshman year. I just really, fell in love with it. I had some great professors and people that I think I got enamored with the idea that economists can do good in the world. I don't know if I believe that every day, but that, very interested in policy. And I've had, the privilege to work at the Fed and also did a year at the White House and did some advising at Congress. So, I mean, that's kind of been my entry point. I think the tools, the quantitative, I love data, trying to measure what's going on, trying to make sense of it. So, but it was that kind of tie into policy that really got me into it.
What's been the biggest shift in the industry over the last 20 or 25 years?
Yeah, I think, goodness, it's a tough one. In some of the spaces that I'm most familiar with, there has been, there's just an explosion of data. And I think it's one where, economists have, because in a lot of our, there's a lot of respect for quantitative methods and how do you think about causality, a lot of, and also the tradition, I kind of grew up in, doing my PhD at University of Michigan, you can go and collect data and you try to let the data speak, and you to learn these methods. And just over time, the amount of data and information that, often private sector sources or things that are, you're learning skills on how to go out and collect data and work with really large data sets. And there's kind of an area of economics that almost kind of, melded into data science and working with the big, with some of the big private companies, the tech companies. So I think that's change. I guess I appreciate the empirical bent. I mean, but you need the theory to inform the data, like in terms of how you look at it. But that's probably been one shift that's an important one, the big data.
How about AI? How is that? To what extent has that permeated your workflow? Because it's a very fine balance, right, between allowing automation and making sure that the data, the input remains qualitative and high caliber, and that the processes, keep the right protections in place.
Yeah, I mean, this is one where I'm personally still kind of finding my way with using the AI tools. I mean, people coming out of school are always on the cutting edge of like the tools and how to use them best. So, and I have had some, like I kind of use it as often a tool of like, this area, what else should I be reading? Like trying to, do background and in places where I feel pretty confident in my understanding of it. So it's just trying to like get some, like I can be a pretty discerning user, but I certainly have gotten burned a couple of times trying to track down some little factoid where I just wasn't sure. And, and ChatGPT was very sure of its answer. And in the end, it's like, nope, you were not right. And I do have to be careful because I would usually, it's like, well, if I can't figure out something with the data, I'd just email the BLS and ask them, hey, what's up with the date? Instead, it's like, oh, ChatGPT says it's this, that, and the other. And I'll check some links on it. But I still haven't gotten to a place where I'm comfortable with it. But I still, it's a tool. It can have uses, but I keep trying to, talk to like younger colleagues at work who are more into using it to get like best practices. Like, how do you make this happen? So I'm curious about it. I'm trying, but I wouldn't say it's really changed how I do the work I do.
You're also the founder of Somm Consulting. Could you tell us a bit more about what kind of advice you offer for clients?
Right. So mainly the consulting I started after I, went independent, had left the Fed, did a little bit of time at think tank, and then decided that I wanted to be in a place where I could have I could have more control over my views and just stay out of the politics of DC. So mainly I've been doing talks and some writing, probably a little bit less of that now because I've been with New Century Advisors, and that's really kind of the focus of my day to day. But for especially giving talks, writing short pieces, like that's still some of the work. But and mainly it is on, it's the work I do, talking about what's happening in the macroeconomy. What do you see in the data? A lot of thought about what's happening at the Fed and because I was trained at the Fed. That's where I learned that's been a big part of my education and how to look at the data, how to think about policy. So that's something that I can share in the consulting work.
Do you miss your time at the Fed? Or is that chapter kind of not done with? I mean, where there's still moments where you're like, you know what? It was a lot of fun. Or maybe certain parts of it were not fun. I mean, you tell us.
Yeah, no, I have so much gratitude for the time there. Not every moment was fun. I mean, I started right before the financial crisis in 2007 and I focused on consumer spending. So like the first year was pretty rough, and stressful times do not bring out the best in people, right? So like there was some rough, and especially and being a newbie who's like just barely keeping head above water. So there were certainly times where it was very stressful, but oh my goodness, I can't even like the people that I worked with, colleagues, bosses, just like, if you're at the Fed, and especially when I was the first 10 years and I worked on the forecast, it's like, it's the staff. It's a staff forecast. And everybody's putting in their views and, we try to put but at the end of the day, like, you don't know the names of the people who do that work. And they're really some of the best economists in the business, but they're doing it as a public, it's like part of the public service, part of the policy work. So I have a lot of respect for it. I miss the people, and the Fed. One thing that I definitely missed after I left, I didn't realize, I would miss so much. They talk, and this has actually been a big discussion point now, but, oh, well, the Fed's always been political. What do you mean political independent, blah, blah, blah. And it's like, I don't know. Like, I mean, really the work inside the building, particularly at the staff level, it's not about the politics. It's about trying to figure out the data. What are the models? What would theory tell you? Like, what's the right policy, as opposed to, is this going to help the Democrats? Is it going to help the Republicans? I mean, once you leave any other kind of economic policy in DC, like, there's a lens of the partisan, right? Like, there's just, and then there's good and bad to that. Like, not everything should be like the Fed, right? Like, or the technocrats. So I definitely missed that, being able to work on policy, but not have to like think about the politics of it. So no, it's a very special place, but it's not like it's not perfect. It's a big institution. It does struggle with groupthink. I mean, it knows it struggles with groupthink, right? So it's not that it isn't trying to, but it's tough. Like, there's just a lot of features of it that make it hard. And they're just like cultural things that bug me. So it's not that I'm like, oh, I wish I were back there. And certainly right now, like, I do not think right now is a nice time to be at the Fed. It really is under fire. But yeah, no, it's a special place, and I learned a lot of great lessons, and I feel extremely privileged to have had that opportunity.
Claudia, this has been fantastic. Thanks again for all your time, and I look forward to seeing you again very, very soon to discuss some of the latest updates.
Yeah, great. Thank you so much.
Thank you for listening to You're in Business. If you've enjoyed the conversation, like, share, and subscribe. See you next time.